This is Talking Capital Markets, where ideas drive the markets. We move past the headlines and into the heart of the deal, breaking down IPOs, M&A, governance, and the strategies driving real growth in today's capital landscape. No noise, no hype, just conviction, execution, capital in motion. If you're building companies, raising capital, advising boards, or deploying investment, you're not just listening, you're in the room. And now, here are your hosts, Mike Blankenship and Brian Jue.
All right, welcome to Talking Capital Markets. I'm Brian Jue.
And I'm Mike Blankenship.
Mike, how you doing today?
All right, Brian. It's been an interesting week, but it's continues to see a lot of movement in the capital market space. So I think it's an interesting time, especially to be a company going public and one that's already public. So it's a good time.
No, absolutely. And for sports fans, I know you like sports, and I got a background in professional sports, and I got this baseball bat in my hand. Sports fans loving today, right? You got MLB's going, NBA's nearing the playoffs, NFL drafts coming, NASCAR, F1, seasons are in full speed. PGA starts soon, got the Masters coming up. So I just named off a whole bunch of acronyms, right? And for someone that doesn't know sports, they might not know what we're talking about and what's what, right? Well, it's the same thing in the capital markets. Every industry is full of acronyms, and there's a ton of acronyms in the capital markets as well. And sometimes, Mike, us being in it and knee deep in it, we forget that often a lot of people don't understand all the acronyms we're talking about. And sometimes they act like they understand, but they really don't know what it is. And so what I'd like to talk about today is one of those acronyms that we hear a lot about, but a lot of people are a little confused about what they actually are. And that's a SPAC, Special Acquisition Company, Special Purpose Acquisition Company. And that's a SPAC, Special Purpose Acquisition Company, right? See,
That's
I
right.
even get them mixed up. Now, these have been around forever. I mean, all the way back, I think in the 80s and 90s, they were used, but we didn't really call it a SPAC back then, and then we just called it a blank check company. And then they came in vogue, and the term SPAC came up, and they had runs of popularity, and then they went away, and they came back. And you, Mike, are one of the foremost experts in the world about SPACs. So what better person to explain SPACs to our audience at Talking Capital Markets? For those that think sometimes a SPAC is just an IPO, it's not. They're very different, but they are both go public mechanisms. And considering that you just got to ring the bell for a DeSPAC, Greenland Energy, let's talk a little bit more about it. And if you could, give our audience a real breakdown about what a SPAC is and what it isn't.
Yeah, no, happy to talk about it, Brian, and worked on many SPAC transactions, both on the what we call the front end, the IPO, and then on the back end of the DeSPAC. So there are two kind of big components here. One, the front end. So typically a sponsor group will be an entity. It could be a private equity. It could be a group of individuals that are operator, been in the capital market space, will pool money and basically form a special purpose acquisition company, a SPAC, typically out of the Cayman Islands. Because of tax reasons, they'll form their SPAC there. They'll have a sponsor, which will be an LLC, usually a Delaware LLC. It could be Texas, could be Cayman as well, could be VVI. That sponsor will initially fund the SPAC with $25,000 to get 20% of the founder shares of that SPAC. And then they'll hire an investment bank, lawyers, accounting, and auditor to take that company public through the S1 process that you would do on a typical IPO. That money raised, typically north of $100 million, is put into trust. And the only amount that's left over is a certain amount for working capital that the SPAC team will use when they're looking for targets. So they'll IPO it, let's make it easy. $100 million they'll have in trust. Once that's completed, they go out and do a search for targets. And usually those targets are, they want to get the high quality, high growth type targets. Today, we're seeing a lot in the sort of biotech, the AI, data centers, areas of high growth with capital intensive capital expenditures. So they need to be public for a number of reasons. One is that it helps them grow. So they'll find these targets and they'll take that target public. And the way they'll do that is they'll do a business combination, so essentially a merger. Could be the SPAC survives, could be the target survives, and it could be a U.S. or it could be a non-U.S. entity. They'll do the merger, and then they'll fill out a form, either S4 for domestic or an F4 for a non-U.S. And from there, describe the business, have financials that are PCOB financials, which, as we've talked about before, important piece and take time to get the financials and get that right. But the target will need those and they'll need pro formas, which means showing what the acquisition looks like together. And then they'll give shares from the SPAC as merger consideration to the target for a certain valuation. So let's say $1 billion. And then they'll do all this. They'll sign the BCA, maybe raise some pipe money, and then they'll do the filing with the SEC, and they'll do a stock exchange application and get approved, and then they'll close it. And so that whole process takes, from the IPO, maybe 2 to 3 months, and then you've got the DeSPAC, which will take 4 to 6 months. And so you have all these like moving parts, and it's just important that folks understand why SPACs are out there. They have been around since the mid 90s. They used to be priced differently. Now it's $10. That used to be $6. There's a whole history around it. But it's a way for companies to see that there was some money in trust. So if you don't have redemption, now one feature I didn't mention is that at the closing of the business combination, there's a redemption feature. And that means that investors in the IPO of the SPAC or ongoing or investors in the SPAC itself can redeem the cash out of it. And why would they do that? Well, one, maybe they don't like the deal. Maybe it's overvalued. Two, a lot of times with the SPAC, it's either a warrant or a right that they're getting when they IPO. So they're going to keep that warrant or that right. So it's an optionality for them to stay in. And if there's success on that particular transaction, then they got it. Why they go in these IPOs? A lot of them come in that are hedge funds and ARB funds because they're getting the yield that's created by having it into a SPAC trust vehicle. So I know it's a lot. It's a big, a lot from, went from SPAC 101 to kind of SPAC 301. But happy to, anyone there in the audience, happy to always have discussions further about it. But it is something that I know well in the capital market space. We did see, I think the interesting part, Brian, is that back in 2021, the SEC came out, in 2022 rather, came out with proposed rules that kind of spooked the market. And you had a lot of SPACs out there. You had 400 or 500 SPACs looking, which is, we've talked about, there aren't that many IPO companies out there to begin with. So how would they get those companies to go public? So there was a glut of SPACs, and it did hurt the SPAC market for a little while. But they've come back. We've seen a lot of good repeat sponsors. We've seen a lot of good activity there.
So a big part of why someone would pursue a SPAC is speed, right? Is speed to market. On the other hand, as an S1 and a straight IPO, there's other advantages there too. When you look at a company, and advising a company, like the business, the privately held business, what do you see that would make them a better SPAC candidate versus a better IPO candidate?
Well, I think, beyond just sort of timing, SPACs lock in that valuation. So the target knows when it agrees that valuation that's what it's going out at. On an IPO, you don't know because you have to get indications of interest. You have to go out and sell it. The underwriter has to go do all that. So, a lot of times it's not easy to know kind of where you're going to sit on a valuation or price per share. Whereas with a SPAC, you know all that as soon as you sign and announce. what you negotiate early on in the LOI phase. So I think that's a big thing. I think one of the higher quality, not trying to be very large entities is something that I think makes it appealing from a SPAC perspective. They can be a little earlier stage too. So it helps kind of grow that. We've, without getting into name, we recently closed a quantum computing company. And so quantum computing, we're not going to see that for several years likely, but we did close it and there's a lot of capital needed. So that was one. Anything out there that's going to energy adjacent has been very, very hot right now. And so all of that is something that I think those kind of companies that have actually been out there, we've seen those kind of growth. And in a lot better ways than, maybe historically where SPACs were doing a lot of these EV companies that didn't really have anything. And so
Right.
I think we're seeing a little bit more success because those EVs were, it's a lot to be a manufacturer and trying to sell on a large scale, whereas you have these other kind of companies that have a lot of upside and really can show some success down the road.
And I think that there's a couple of different ways to look at the redemption process, right? And the money that's in a SPAC, that's in the trust, and then during the DeSPAC process, what sticks and what goes. I mean, we've seen situations where there might be 100 million in that SPAC and only $10 million sticks. And you might see others where a lot more sticks, right? Stays in and goes on with the company. When you look at those kind of situations and where the capital leaves, do you see it more as the responsibility of the sponsor, or is it often the kind of money that they brought in? Is it the company? There's all kinds of different factors there. And whatever it is, having access to additional capital beyond what is in the SPAC, I think that's a crucial piece of the puzzle, right?
It's a fair point. Look, early on the IPO, a lot of times underwriters will put in, not the long hold type, the buy side. And so there'll be more hedge fund type that just want the yield and will come out. If you can rotate that shareholder base that comes in through after the announcement of the deal. So let's say it's a good deal. Retail thinks it's a great deal. If you can get more retail in there, you'll typically see less redemptions because retail is not going to go out and redeem and they're going to believe that they can go out. So like if you and me, Brian, if we go out and see some really cool deal that was announced and we buy shares in that company, it's unlikely that we are going to say, oh, we're just going to redeem out. We're because we go to the market, we just sell. So we're going to see that and there's a potential good deal. And so if you can rotate that base, I think you could see a pretty successful type transaction. But, the company, the story has to be told in the same way that a story is told kind of going forward for a public company, but the SPAC especially because they can tell a story, unlike an IPO. Obviously there are a lot of restrictions around gun jumping and certain disclosures. But the story can be told in SPAC. You can tell the story over time, like this is what we plan to do. And so because of that, you can see more potential growth. And I think that could be something that reduces that redemption factor. But yeah, it's kind of like on all of them because they need to make sure that they have the right mix in there and that they've told the story. A general rule is if it trades above $10.50 after the announcement and stays up, you're not going to have any redemptions or not. But if it comes kind of below that number or below the number where after time with interest that sells, then you're going to have redemption. So if it's trading at 10.20 and the value is 10.20, then you're going to see redemptions. So there are ways to view that. It's just you have to find ways to tell that good story. And so that's why we talk about having the IR firm and others really help.
No, that's a fantastic point. Where do you see the future of SPACs going? How do we avoid a glut again, right? What do you see happening and where do you see SPACs fitting in the marketplace moving forward as the going public becomes popular again, easier and more advantageous for a lot of companies out there?
I think it's obviously one of the four ways, and I think it's going to continue to be one of them that people look at depending on the company and where it sits, and its timeline as a company. I think you're going to see a lot of that, a lot more. It'd probably stick to a number. If you do have a glut and too many, that's going to be problematic for the market. And like any gold rush, you get too many people coming in trying to find something and mining for deals, and you get too many miners. And so hopefully we don't see that. And the market will correct itself. It'll show certain investors won't do the kind of size deal to $10 with 22 years with maybe a half warrant, quarter warrant, whatever. It may be more unfavorable terms for the sponsor, but favorable for the investor if we start to see a lot more. And that's kind of what happened several years ago. And I think that is something to keep track of, because we need more DeSPACs closed, more announced, more closed. And because there are about 200 so SPACs out there, so 220 searching, we have about 100 announcements. So you still have 100 plus, 200 plus type SPACs that need to find deals. And so hopefully we see some of that cash come back out as it's redeemed and come back into the market.
Mike, really appreciate the education. It's fantastic that we have access to you to be able to talk about everything that's going on in the marketplace, and with the experience behind it as well. So thank you again. As always, we are talking capital markets. I'm Brian Jue.
I'm Mike Blankenship.
See you next time.